Well, what time were they supposed to be here, Ed? Why didn't they? Here's the question I'm gonna ask you this question. Magic question. Do you take it personal they're not here?
Yeah.
Do you? Yeah. Why do you take it personal? Who?
You didn't take it personal. You know why? You didn't take it to them. You're just relaying the message they're telling you.
You didn't take it personal. If you're on here, do me a huge favor. Like, comment, and share the stream if you're in the studio with me. Welcome to Real Estate 101. Hayden, why ain't you here, man? Damn, I remember, you know what I used to do if they weren't here by 1, I'd just send them out of here like I do you, dipshit Ed. That's what I would do from time to time. Hello, Ali. Let's change your spelling to A-L-I, like Muhammad Ali. Happy hump day. Welcome to Real Estate 101. Every Wednesday, 1 o'clock, we come on here live and talk about real estate, relationship, business, money. Today we're talking about mortgages. We're talking about real estate. But we always like to give a big shout out. I'm going to share my stream real quick. Have you shared it over there, Ed?
Yep.
You swear?
Swear to God.
I'm going to share it myself right now.
Hayden said he's en route.
Who do you see? I shared it. Why mortgage rates still suck. Are y'all on the show yet? You could have been driving down the road and gotten on the well, I'm going back to the old school way.
Yeah.
Hayden's in route. All right. We always begin with a big shout out to somebody. Who is somebody we'd like to give a shout out to Weatherman?
Hey, probably I'm going to go with a TriStar, because we got a whole bunch coming over.
We got TriStar Title. We got a lot of closings over there. TriStar Title, thank you so much. Another shout out, if you need to sell your house fast, see this instant offer right here. We got to tighten up how we're doing that. But you go right there to the GTT offer. We can hook you up with an offer from some of our friends. Are we still moving, Van? I'm frozen. I don't know why. I don't know what's going on. But I started making these predictions that mortgage rates would be lower by now. I really thought they would. All the signs, fundamentally, everything looked like inflation is going down. Inflation goes down, mortgage rates follow. A lot of people have seen how the Fed has raised the Fed rates. I don't know if it's been 10 times. They've raised it so many times, and they've seen mortgage rates go up, but that's not the reason. Then my computer's really spinning. I don't know what's going on. Can't see anything. Am I on?
Yeah, you're on.
Are you on my show?
Yeah,
my
phone's charging.
Okay.
I'm
So I'm just going to get off that. It's driving me damn crazy. So as the Fed has raised the rates, the reason why the Fed has had to raise their rates is because of the inflation number. Last year, the CPI was 9.1%. They want that a lot lower. They want the core inflation rate to be 2.0. Right now, it's in the 5s. So we're way above. The Fed probably waited too long to start raising rates. They didn't start raising rates until it was already out of control. So what that has done is it has created month after month, meeting after meeting, where the Fed has continued to raise the rates. So fundamentally, mortgage rates should not be where they are right now. If you're looking at the fundamentals of inflation, by now, mortgage rates should probably be closer to the 5s. So why are they still going up? Fundamentally, they're looking better, but things are going on in our marketplace that's unintended of what the Fed was doing. A lot of people said, well, whenever you start raising rates like this, there's going to be some breaks. There's going to be some breaks in the economy. So
There's also the guy that we met in Florida, was very, very smart. He said that a lot of times, too, during the election years, everybody's scared to teeter-totter both sides. So you deal with some of that stuff, too.
well, right now we got the debt ceilings talk going on. We've got elections. A lot of people do get skittish. But here's one of the biggest problem we have right now for mortgage rates is community banks, the way banks, especially community banks, the way they make money is if I were to give you $100, you could go out and lend $1,000. That's leverage. That's how they make their money. So back in the 2 years ago, the Fed funds rate was probably below 1%. For a community bank to make money off of borrowing money and lending it out, it needs to be 4% higher than what they borrow it for. So if they're borrowing it at 1%, what is the consumer going to borrow at?
If they borrow 1%?
Yep. If the bank, say it. 5. Now, how did you come up with that number?
So that would be 4% higher than what they borrowed.
Okay. So community banks back then, those rates were about 5%. They got a little lower. So let's take me, for example, right now. And whenever you're dealing with like these community banks, you're usually on a 5-year term. So I've got a portfolio loan with Pinnacle right now that's at 4.75. It does not mature until August of 25. Would I want to refinance that loan right now in this current environment if I had it at 4.75? Today, they're borrowing money at 5 to 5.25. So what would my rate be? It'd be way up there. They might bring it down just a little bit to get competitive. So would I be willing to exchange a 4.75% rate for an 8.75 to 9?
No.
So see, the bank, who's really suffering right now then? I'm locked in. My rate's 4.75%. Nope. Who's really struggling right now are the banks. God damn, man.
Oh, did it hit you?
Yeah.
Oh, I can't see.
So who's really struggling right now are community banks that if they are having to pay out right now 5%, or they're borrowing the money for 5%. They're already losing money off me right now. How much money are they losing on me? I'm 4.75%. Now they're losing a quarter point off me and a lot of other people that have had loans in there for a few years. Do you see how that's working? Right now, banks are getting killed. The other thing that's going on is people that's got money in their account, if they can go and take their money out of a bank and put it into a brokerage account to where if they're earning 1%, I can go over here to a brokerage account and get 4.5%. Where are people moving their money? They're moving it to things like
It's like a stock account or something.
they'll move it somewhere to get a higher guaranteed yield. So whenever they get to pay, if somebody's commenting or asking questions, let me know. Edward, does anybody ask a question?
Yes, well, Hayden said, come on, 5, SSS. Somebody's talking about Stevie.
5, come on, 5.
Yeah.
I don't know what that means. But keep looking because my computer's not working right now. So the other problem that's going on, people are pulling their deposits out of banks. And whenever banks, where they're told they got to keep their money, they got to keep a lot of their money safe in treasury bills. So if banks started putting their money in treasury bills, let's say 2 years ago, they've got their money parked over there, depositors are wanting their money. What's happening is the banks don't have enough money. They've got to go liquidate. They're liquidating their treasury bonds. So whenever you liquidate a treasury bond, whenever you sell the bonds, the price goes down. When there's more sellers, it drives the price down. But bonds have an inverse relationship. Here's what that means. If prices go down, yields go up. So if bonds have a par of 100 or 1,000 or whatever denomination you want to call it, as the bond price goes down, interest rates go up. Does that make sense?
Is that what happened?
So there's a bank in California. I forgot it was the first bank that failed. They had to liquidate all of their treasury bonds. They had to go in there and sell all their treasury bonds, and the bank failed. Do you remember what the name of the bank was?
Was it Wells Fargo?
No, hell no. Wells Fargo's alive and kicking. But this bank lost $2 billion They lost $2 billion because they sold their bonds at a much lower price than what they paid for them. What was it, Van? Silicon Valley Bank. They went under because people pulled their money out of the bank. People pulled their money out of their deposits, and then, the bank, to secure it, they had to go liquidate their assets, and then they're underwater. They're out of business. So here's why mortgage rates I'm finally getting to my point. The reason why mortgage rates are still going up right now is because mortgage rates follow 10-year Treasury. The 10-year Treasury a couple months ago was about 3.3. Historically, mortgage rates should be about 200 basis points above the 10-year Treasury. If the 10-year Treasury is at 3.3, where should a 30-year note be, or a 30-year mortgage?
5.3.
5.3.
The man's on fire.
The man is a genius right now. But what has happened is, with all the selling of treasuries, it's pushed up the yields. Now the 10-year Treasury is back up to about 3.75. Historically, that means mortgage rates should be...
What is it at now?
It's
3.75. 5.75.
should be 5.75, but everything's out of whack because servicers know sooner or later they're going to refinance, or customers are going to refinance, and they're going to get a lower rate. Well, the way services are making their money right now, or these lending institutions are making their money right now, instead of doing 200 basis points, they're doing 300 basis points. Good luck to you, kiddo. They're doing 300. So now, instead of it being 5.75, the rates are
6.75.
6.75. You're on top of everything today. So I thought, and fundamentally, inflation has come down, but mortgage rates have not followed it down like it historically does, because we're in this banking crisis right now. So when will this end? When will mortgage rates start to come down? I think.
I'm sorry.
Go ahead.
You said that traditionally the 10-year Treasury should be 200 basis points lower than what mortgage rates are, right?
Historically, if you look, whatever the 10-year Treasury is,
200 or 2 points.
it's 2 points, 200 basis points.
Why is it 3 now?
It's 3 because servicers know there's going to be a lot of refinancing. So the way the servicer, they lose money unless they hold a loan for 6 months.
Who's a servicer?
Like if Ed was to buy a house, he goes to you to buy the house. You do the mortgage. Mortgage companies do what's called mortgage-backed securities. So this company pulls all the loans together and they sell them to the secondary market. That's who buys them.
Right.
So you don't sit there and you don't keep loaning out $200,000. You sell the loan immediately. So like in our mortgage company, we do everything through First Community. First Community, let's say there's a couple hundred closings in a month or however many they do, they pull them all together and they sell them to Wall Street.
Well, yeah, like a big
So the Wall Street people, they're putting this little bit of a premium because everybody knows we're in a temporary time here. So they're putting like if you ever go to Nashville and you're going to Uber back and there's tons of people. Uber has what's called like a surcharge or something.
Yeah.
Right now there's a surcharge or whatever going on with servicers and investors. So it's just a lot higher than it should be. Well, when will this end? I think it's going to end whenever people feel comfortable leaving their money in the bank. Do you ever hear people talk about, man, you need to get your money out of the bank? People are saying that.
Yeah.
And what happened to that Silicon Valley Bank is word got out, and within a day, everybody started pulling their money out. The only way they could pay like if you went to the bank, they may not have all your money there. If John Floyd went to the bank and said, give me all my money, they probably don't have it there. They've got it lent out. You can lend about 10 times what you have in deposits. So they don't have all that money. They're going to have to go out on the street and get their money back. So whenever people feel more confident that people are going to stop doing that, and whenever the Fed finally says, hey, we're going to start cutting these rates. How long could it be? I don't know, but it's going a lot longer than I thought. That was a long explanation of why.
That's very insightful.
Is it? Did it help you?
Yeah, I didn't know that's why it was. Because I'm looking at the 10-year Treasury on that screen right there, and I see 3.75. I'm like, well, shit, they should be at 5.75 now.
Well, that's right, but they're still not. They're not.
6.75.
They're 6 point, and they're going up. It feels like. Hopefully, though, sooner or later, the fundamentals will win out. Sooner or later, whenever inflation comes back down, and it looks like it's coming, it's come down 10 straight months. But damn, rates have gone back up. A lot of fear. People are scared. Banks are the one that's really suffering, especially the smaller banks. So the big banks love this opportunity because they got plenty of money. They can just sit there, fade, and let all these little guys go out of business. If you think there's not one real community bank left in our town, there ain't one. I mean, nope. First Bank. I mean, it ain't a local community bank. It's a West Tennessee. But I mean, there ain't one like in the old days. Do you remember First City, Bank of Murfreesboro? I can't remember some of the banks, but man, they've all gone.
Because of times like these, right?
Say what, Van?
What about Wilson County? That's a local bank.
Well, I mean, it ain't a Murfreesboro local bank. That's a Lebanon local bank.
Well, but like, why did they not survive the local bank?
Well, look, if I ever wanted to start a bank and I said, hey, guys, let's get all of our money together, and here's what we're going to do. We're going to get some money together. We're going to raise some money. We're going to issue some stock and some bonds, and here's what we want to do. We eventually want to sell this bank to Regions or to Pinnacle. So that's what ends up happening. But community banks are so vital to local economies because it's a lot easier for us to go over there, talk to Ronnie Martin, and say, man, I need a little money. Can you help me out? As opposed to going to Wells Fargo. Where do you bank?
I bank at Bank of America.
Do you? Where do you bank?
Pinnacle.
Pinnacle. Where do you bank, Josh?
Ascend. I go to Ascend.
Where do you bank?
Ascend.
So you really need to bank with somebody that's local if you ever want to borrow money.
I have a Pinnacle account for that reason.
Well, they're going to look and say, why don't you, family, stop right there. They used to always stop right at 15 minutes, but you really need a local relationship if you ever want to borrow money. But that's why. So in a nutshell, mortgage rates are going up because banks are hemorrhaging. And what they've got to do is they've got to sell off their treasuries. And when they sell off their treasuries, it pushes prices down and yields go up. Does that make sense?
Say that one more time.
Whenever it's an inverse relationship. Whenever you sell a bond, prices go down, but the yields go up. The interest goes up. So that's what's continuing to happen. Shut us down, Vingretin! I don't know why my computer's...